Kia ora and welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Helen Mattison, and today on the program we're going to talk all things dividends. Should they be part of your investment portfolio in these difficult times? What's the best, cash or shares? And what sort of yield can you expect? Joining us today to help answer these questions is Victoria Harris from The Curve. But before we cross to London, where Vic is, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Victoria.
Hi, Helen. How are you?
Great. Now, tell us about London. What's the weather like? Is it hot like the Mediterranean? You look like you are in the evening, so perhaps not.
Yes, no, it's pretty warm. It's warmer than Auckland, that's for sure. But it's not as warm as I think the 40 degree, 50 degree temperatures that they're getting in Italy and in Greece. So no, thankfully that would be quite unbearable, I think, if London was that hot. But no, it is nice to be warm and it's light. I mean, it's only just gone dark and it's about 10 p.m. at night. So that makes for that makes the days nice and long and lots to do in the evening. So yeah, no, it's good. It's good fun.
And are you there for pleasure and work?
Yes. So I came over here with the expectation of, doing a lot of European travel, and I guess it's a good thing and a bad thing, but probably more of a good thing that work's actually been really, really busy, and meeting lots of interesting people over here and kind of putting our feelers on the ground in terms of expanding the curve over here. So yeah, it's been pretty whirlwind. I've been here for 2 months and it's just gone so quickly, and we've got another 2 months here and then we head home. So yeah, a bit of work and a bit of pleasure. We definitely chose the right time to come to London, coming over for summer. So yeah.
Now let's jump into it in terms of dividends then. It has been the season. Many Sharesies investors will have seen those notifications on their app with you've been paid this, that, the other thing. Let's perhaps start with the basics though, which is always a good place to start, in terms of what is a dividend, who's eligible, and how often might you be paid a dividend?
Yeah, so a dividend is effectively a payout of profits. So it's when a company makes, I guess the company's pretty confident in the outlook of their profitability, what they expect in the next few years. So they're like, you know what, let's return some money to our shareholders. They don't return it all. It's usually a portion of their profits that they'll pay back. And it really creates a part of your overall return as a shareholder. So your return is kind of made up of a share price movement. So say your share price went from $100 to 110, then you've made $10, but you might have a $2 dividend that was also paid out. So your overall return is actually $12. So it's when companies effectively just pay back, they can pay back money to investors, kind of as a thank you for being a shareholder, I guess. So yeah.
And do you have to be with the company for a certain amount of time before you might get a dividend payout?
Not necessarily. There's certain cutoff dates, but it's not a case of you have to be a shareholder for a year or 6 months or anything like that. They do. Companies usually pay dividends, particularly in New Zealand, they'll pay them 6 monthly, which is an interim and a final dividend. Usually the interim sometimes, and I'm talking most cases, but there's always outliers when it comes to investing. There is usually a interim dividend, which is smaller, and then there's a final dividend. But yes, it's usually twice a year. And no, you don't have to be a shareholder for a certain amount of time. Yeah.
Is it fair to say that it's mainly companies and possibly funds that are well established that would pay a dividend? And I'm just wondering if you can give us some examples and also whether or not that's changing in this climate. We've had lots of volatility, we've had COVID, business is changing. And I'm wondering whether the old adage that if you need dividends, you're probably older, you're needing for returns, you're not into growth investing. Does that still stand?
Yeah. So when, like you said in the beginning, dividends, it kind of seems a bit of a boring companies, or, it's not the exciting, hot, spicy, investments that people like to talk about, but they are really important because dividends are usually paid by companies that either have a really steady profit or have been around for a long time. So they've been through business cycles, they've been through investment cycles, they know their business and they know how it operates, they know it's survived through the thick and thin. And so these are usually the pretty boring companies. So I'm talking utility companies, I'm talking telecommunications companies, healthcare, those real stock standard, solid defensive companies, which tend to be the boring ones. And so, yes, you're right that usually also a lot of older people invest in dividends because they get paid the dividend. And so if you're living on a low income or a pension or superannuation, then that's a nice little top up. Whereas younger investors, they're not as worried about that. So they're like, you know what, I'm maybe going to invest in some more higher growth, a bit more exciting companies. And those companies tend to not pay a dividend because when you pay a dividend, you're paying out your profit. Whereas those companies that are growing, that are high growth companies, they reinvest their profits because they're reinvesting them back in the business to grow and grow and grow. And so, they're on that really kind of fast, accelerated growth journey. So therefore, they're not paying money back to investors, they're reinvesting it. The thing with that is that their share prices tend to be a lot more volatile, which over the long run is a good thing. It can lead to to greater returns, but that's why you kind of get older people investing in more dividend companies and younger people not so much. But there are some pretty impressive dividend payers, that are companies that we use usually like on a regular basis. Like a lot of us would be surprised at some of the companies that pay dividends or have historically been quite long payers of dividends. Companies like Coca-Cola, these companies have paid dividends for over 100 years. So this is really, really consistent, stock steady companies. And this is like Coca-Cola, Colgate-Palmolive, Procter & Gamble, ExxonMobil, all these companies that we probably know quite well. And we use their products, probably on a daily basis, many of us. And so, it tends to be those boring companies that kind of fly under the radar that are more likely to be the dividend paying ones.
In these volatile economic times, are we also seeing fewer companies paying dividends and maybe the dividend payout or the yield, if you like, is less? Is that a trend that we're seeing, or is it a bit too early to tell?
Yeah, so during COVID, there was a lot of companies that were like, oh gosh, I don't know what the future's going to hold. We've never really had a global pandemic like this where the world is literally shut down. Let's just cut our dividend and keep the profits because we don't know, if we'll be able to sell product or we'll be able to actually make any revenue. And so a lot of companies did that, and that kind of gave quite a bad signal to investors because if you cut your dividend, a company cutting its dividend is a bad signal because it looks like they're uncertain about the future of the business and the future profitability. And so as an investor, that's not a really good sign. And usually that leads to their share price falling as well. So a lot of that happened during COVID. A lot of share prices fell. A lot of companies cut their dividend. Then we kind of came out of COVID and everyone was like, it wasn't that bad. And there was this big pent up demand because we hadn't been spending. And so a lot of companies came, or really accelerated out of COVID in terms of their profitability, their revenue, their share prices. There was a lot of, I guess, positivity and kind of hysteria and a lot of positive economic news, or more positive than we expected. So this led to a lot of companies then, paying, reinstating those dividends, but also paying special dividends, especially the tech especially the companies that, did do quite well during COVID. But I guess now we're kind of seeing as we head into a recession, or, in New Zealand we are in a recession, but, there's talk of the US and there's other countries possibly heading into recession, that, these are the companies that tend to do well in a recession because they're companies that we use on a regular basis, that we need in our everyday lives. We need to turn the gas on and we need to turn the power on. We need to use our phones. We need to shop at the supermarkets, all that kind of stuff. those companies are dividend paying companies. And so there is a bit of a trend now moving towards having more of those in your portfolio, or more investors investing in those. And I think it's also good just from a diversification point of view, to not have all your eggs in one basket, whether it be high growth names or all in dividend companies either. It's kind of having a mix of both is always a really good idea. Diversifying across anything is a great idea, whether it's a different asset or a different sector or different type of company, like a dividend or a growth company. So
let's talk about the yield then. Normally that's displayed as a percentage. I mean, what sort of things should an investor be looking for when in terms of the yield?
Yeah, no, it's a really good question. And so the dividend yield is the payout over the price. So the dollar amount over the dollar of the share price. And so that's how you get the percentage. And obviously with the share price changing every day in the stock market, that means that the yield changes every day, because the dollar amount of dividend that's paid out is static, and then the share price changes all the time. So the yield percentage does change, but if we look at yields overall, usually I guess a good dividend would be anything maybe around 5%, even kind of that 3, 4, 5, 6%, I would say would be quite an attractive dividend yield. If you're getting down to the low end, you kind of want to be compensated with some share price movement or share price growth as well. And if you're at the top end, so say you're getting a 10% yield, that might on the scheme of things sound amazing. You're like, cool, I'm getting a 10% return from just holding the stock. But I would be skeptical, just because, I don't know, we always used to think there's probably something you're missing. If a company's paying out 10% of its profits, 10% as a dividend, if it's got a 10% dividend yield, then it's probably either the share price is too low, and therefore, there might be some bad news coming. There might be a profit downgrade. There might be something that you're missing in terms of maybe a competitor is getting, really strong, or there might be something that is about to impact the share price, or the share price might fall, because that 10% dividend yield is quite high. And usually you kind of get to a tipping point at that level where there's something distressing or something's wrong. It's not going right with the company, because that share price is so low, or is going to go lower. So that's just one thing to be aware of.
In terms of payout then and the yield, and wondering whether the yield, if it's very high and you're thinking, oh, is it alarm bells? Maybe we should think about if there's been any recent examples of that, Viv.
Yeah, no, definitely. Well, in the New Zealand stock market, and it was on the Australian stock market as well, actually, was my food bag. And they are a very cash generative business, actually. And so they had a very strong dividend yield. They paid out, a lot to shareholders, and returned a lot of cash to shareholders. And then their share price started to fall, pretty much as soon as they'd listed, to be honest. And, their dividend yield was getting very, very high. And there was, I guess, skepticism in the market that something wasn't right with the business. There might be a profit downgrade, that they might not be able to pay the dividend because that dividend yield was getting so high, because the share price was falling. And lo and behold, eventually they did have a pretty severe profit downgrade. They were huge beneficiaries during COVID, and then that all normalized. And they had a profit downgrade, and they actually cut their dividend as well. So from an investor standpoint, it's kind of, if things are too good to be true, they usually are. And, we saw that when you're getting, I think it was over, 15% return dividend yield. It was very, very high. Then you start getting alarm bells, or, your senses should be a bit heightened into, is there something else going on in the business? And so, with my food bag, that was definitely the case there. And it kind of did play out that the dividend got cut, and the dividends getting cut is never a good sign to investors, because it does mean that the company's not in the best financial position, or the outlook doesn't look that good, because they're trying to preserve that cash to operate the business.
which is what we did see. Yeah, and
Yes,
some of
yeah.
the earnings reports of late, there has been some changes in the dividend that has been paid.
And I think with dividends, it's consistency is kind of key. So a lot of companies, that you don't want to increase your dividend payout and then decrease and then increase, because investors like certainty and investors like consistency. So one way around that, if they do have, I guess a lot of cash or have a really good, a few years where they've got good profits, is to do a special dividend, which is kind of a one-off, like, hey, we've had a really good year. We want to return some cash to shareholders because we can't find anything else to spend it on that we think's worthwhile. There's no companies we want to buy, or there's no, there's no other things to do with the money that are a good return on investment. So you know what, we're going to return this money to shareholders rather than just sit on the balance sheet. So that's always a good indication it's almost like a thank you as well, but without having to chop and change that dividend payout and mess around with the dividend yield and all that. Because consistency is kind of key when it comes to these kind of companies.
What about payment then? You can get dividend payments through shares, or it can be in cash, and there are pros and cons for each of those. So let's unpack that.
Yep. Yeah, so you can get dividends paid out as stock. Usually there's a bit of an incentive, so there'll be a little bit of like a discount to encourage people to buy those shares, because otherwise you'd just be like, you know what, if I want to buy more shares, I'll just buy them on the market. So it has to be, there has to be some kind of incentive to make you buy them. And I think with that, you would probably do that if you really believed in the future of the business that you're investing in, and you wanted to gain more access, to their stock, or get more shares, and get them for that discount. Otherwise, and maybe for those older investors, they might be like, you know what, no, I actually need the cash. And so it turns out to be much of a muchness in terms of your in terms of the option that you choose, if that makes sense. So it's personal preference really, in terms of whether you take the stock or you take the cash. But yeah, and it kind of depends. If you need the cash, then you might take the cash. And then a lot of people actually reinvest as well. So you might be like, you know what, if they didn't offer shares or stock as a dividend and they only offered cash, you might be like, you know what, I actually just want to reinvest that and, improve keep my growing my portfolio, keep reinvesting that cash, so then those returns compound on each other, and I can keep growing my investment. So yeah, lots of options and lots of confusion, but that's investing for you.
Are there tax implications too for taking the stock or taking the cash?
Yeah, so when you take the cash, you do have to pay tax on the dividend income, but there are imputation credits, because when a company pays a dividend, it's taxed because it's paid out of its profit, so it's already taxed, that dividend. So then when you get it, and then if you have to pay a tax again, then it's double tax. It's double taxation. So you do get an imputation credit which offsets that, so you're not paying the double tax. So that's an incentive as well.
I think probably just the words that people need to probably be aware of are the imputation credits. And also another word that you often see, particularly with Australian shares, is franking credits, that sort of thing. And I think when things aren't fully franked is something that investors probably need to think about as well.
Yes, yeah. So it's I think imputation credits and the fully being franked is the same thing, just different terminology. Yeah. So you can call imputation credits, tax credits, franking credits, and yeah, it's depending on where you're investing, whether it's in Australia or New Zealand, then yeah, it kind of depends on what it's called.
In terms of what you do with the payments, I mean, as you said, there's lots of options. A number of companies have in the past, and I'm not so sure now, I'm wondering whether you know more, have offered dividend reinvestment plans.
Yes, yeah. So a lot of companies will offer this as a way of you, I guess, not taking the cash and reinvesting that money. Again, it's kind of personal preference. I think I haven't noticed any increasing trend in this over the years or any change. It's kind of, I guess if you needed, I guess for a share price, if the share price, hadn't done too well and you wanted to take the cash, then that could be an option. But yeah, it is, again, it kind of comes back to, I guess, what is your goal, or what is your investing time horizon, investing goal? If you're wanting X amount by X number of years, then reinvesting that cash and I guess putting it to work and making it grow is probably more of an option. Whereas if you needed the dividend income, then that's when you'd be more inclined to take that and kind of live off it, so it supplements your income. But yeah, for younger investors, I guess you'd probably, and this is not advice or anything, but you're probably more inclined to reinvest that money and use a dividend reinvestment plan than take the cash and just sit in cash into your Sharesies account.
I suppose with the dividend reinvestment plan too, the company is doing quite a bit of the heavy lifting. You don't have to worry too much if you've signed up for
exactly.
that.
Yes,
that would be another thing to think about.
Yeah, that's very, very true. Yeah,
I suppose the swings and roundabouts too for some of those what we call defensive or true and tried companies that have always paid a dividend. Just looking at the NZX figures for the last financial year, I've seen that the industrials, which obviously is things like Fletcher Building and the like, real estate, utilities, Contact Energy, those sorts of companies, those seem to be the top three in terms of yield, whereas healthcare and logistics, I think, took a bit of a downturn with things not being so rosy for them. So I suppose it's a matter of thinking about what's happening with the economy, not just about, this is my dividend paying stock. What would you say to that?
Yeah, and I think it's really, really good point as to, not always look at dividend yields and dividends with certainty. I think, you can get not complacent, but you can get used to a company paying a certain percentage, returning you a certain percentage in terms of a dividend. And yes, you're 100% correct. There's business cycles, there's economic cycles. Some companies are going to do well in certain periods, some aren't. We've just been through, a really and very, unprecedented. Thought I'd stop saying that word finally, but I haven't. Unprecedented time in the last, 3-4 years, and so, these companies are still seeing the side effects of that, and so it is something to be aware of. To not always, think that is a given in terms of a dividend yield, but obviously, the longer that a company pays a dividend, the more attractive or the more certainty you can get around them paying that in the future. So, if they've constantly paid through recessions, through really boom times, through pandemics, through global financial crises, then, it does give you a bit of certainty that, the business can continue to pay a dividend no matter, I guess, what the cycle or what the economic situation.
Are there any stats that you've seen that are interesting for retail investors in terms of whether you invested and took the dividend or whether you didn't?
Yeah, so there's actually, there's actually a really interesting stat. And if you invested in the S&P 500, so the top 500 companies in the US in the 1960s, and so a long time ago, and so say you invested $10,000. And you didn't take any dividends. So you took the dividend, you didn't actually reinvest them, then you would have had $641,000 by the end of last year. If you had reinvested those dividends, that $10,000 would be over $4 million. So it really does show that, yes, you're still getting that return when you take the dividend, out of your portfolio. It's not, when you don't reinvest, it doesn't compound, and therefore you don't get that that kind of exponential return over the long term, or that compounding return over the long term. So this is why if you are younger and you are investing in dividends, just to weigh up those options in terms of do I need the cash? or can I reinvest that and really help compound that growth in my portfolio over time?
So a growth stock might be something that you want to look at in terms of dividend payout, although many of them probably don't have that option. However, over the long term, maybe you want a bit of both in your portfolio, are you saying?
Yeah, I think it's, we are, in a pretty testing time in terms of the economy at the moment in, most countries around the world. And so, yeah, I think there is, we've seen growth, do fantastically well over the last 10 years or so. And then, last year, not so well. And so there is definitely, I guess, scope to have dividend paying companies in your portfolio. Definitely diversifies your portfolio, and there'll be times when dividend stocks do better than growth stocks. But yeah, it's just a case of asking yourself, do you need to take that dividend, or can you reinvest that dividend? Yes, it's a dividend paying company, but you also have the option of reinvesting that dividend and not taking it as cash. So yeah, there's options out there.
One thing we haven't talked about, Vic, too, is it's not just companies that pay dividends. There are a lot of exchange-traded funds, for example, that do pay. So is that becoming more prevalent and people are realising they're getting dividends and they didn't even realise that was happening, or how does it work?
Yeah, so with an ETF, so you're effectively investing in the companies within the ETF from the exchange-traded fund. So you own, even if it's 1 or 2% of that company, which makes up that fund. So you're entitled to that percentage of the dividend. So you're investing through an ETF, but you are actually investing in those underlying companies. So you do get that dividend paid out. Otherwise, you just go direct, because for a lot of the S&P 500 companies, a lot of them are dividend paying companies. So this is definitely, it doesn't really matter whether you do it directly or whether you do it through an ETF, you still get that exposure to that dividend, because it does make up part of the overall return of a company.
So it's really more about what you do with that dividend.
Yes, yeah. So it's really about whether you take that dividend or you reinvest it. But you're entitled, just because you own the company or the shares in the company through an ETF, you're still entitled to that dividend, even though you don't own it directly and you own it through the ETF, you're just as entitled to that dividend. Yes.
So, Vic, I think we've done quite a good job on making sure that dividends aren't such a boring subject. So thanks for having the time with us today. Before we leave, though, just wondering, is there one takeaway for people that if they don't listen to anything else in this podcast that they might remember and think, oh, that's what I need to know about dividends?
Yeah, I think it's that dividends, can actually play a key part in your portfolio. They can provide, defensiveness, and they tend to do well, during times of recessions, or when economic growth isn't doing that well. So they do actually have a place in our portfolios, and I think it does provide good diversification. Even if you do think they are boring, there are some pretty sexy ones out there. So yeah, they do play a really important part in diversifying our portfolios, definitely.
Thank you. And thanks everyone for joining us today. And please give us a rating on your favourite podcast app. Victoria, it's been great to have you on. Enjoy London, and we really appreciate your insights.
Thanks, Helen. Thanks for having me.